Many high-income earners and short-term rental investors are missing out on massive tax savings. In this video, I'll break down the 4 smartest ways to use the short-term rental loophole to maximize depreciation and keep more of your income. My name is Jeremy, and I've personally bought 10 short-term rentals, 2 of which are my own, and 8 with business partners. And together, those properties have generated millions in revenue and tax savings. I've also helped others buy dozens more, and I am a co-founder of BNBCalc.com, a software tool thousands of real estate investors are using to run the numbers on rentals. The first thing I want to get into is the importance of the structure to land value ratio. Depreciation only applies to the building, not the land. So the higher the structure to land ratio, the more you can write off. So for example, let's take this property in Kentucky we bought earlier this year. It is quite rural, so the land value is lower and the property value is predominantly the house. So this will definitely help us a lot from a depreciation standpoint. Also, it helps that the property within a couple months of being booked had over 6 figures on the calendar. Definitely have strategies and ways for that side of things too, but today we're just going to talk about the depreciation aspect. Second, how do you optimize timing? You're only going to get the bonus depreciation if your property is placed into service in a specific year. There are a couple other requirements, 3 rentals, 7 days or less in order to get the active participation component. Definitely check with an accountant on all those aspects. But that being said, you're going to have rented it or have time to rent it in a calendar year, which means by December 31st of that year. However, you don't necessarily need it up a full year. So I think a lot of folk think that, they need to get the house in January, February, March. Actually, if you get it up in the latter portion of the year, it might actually be more beneficial from a tax perspective because you're going to have less property revenue to offset. So for example, that house we bought in Kentucky, we purchased, I believe in February, March, we got it up towards the end of May, and it already has, 6 figures of revenue on the calendar for 2025. That revenue is going to decrease the loss we could show in year 1. So if you get something up in November, you'll likely have a handful of rentals, but you won't have like crazy revenue that's going to offset that depreciation loss. Definitely don't stress yourself out and wait to the last minute, but there might be an advantage to getting the house in service in the latter portion of the year. Now, third, optimal leverage. What does that mean? Well, depreciation is based on the purchase price, not your down payment. So if you buy $1 million property with 20% down, you only actually put a cash outlay of $200,000, but you can depreciate the structure value portion of that $1 million. So that's how leverage can actually supercharge your tax savings. So it doesn't matter if you put 0% down, 10% down, 20%, it doesn't affect the amount of depreciation you're going to show. So a lot of folk, what they'll do is, do lesser down payment. Obviously, there's other variables here beyond tax savings, but that is something that is important and you should know. How do you optimize your renovations and furnishings? Not all renovations and property setup costs are equal. Like repairs, like fixing leaks or patching walls, usually you can deduct those right away. Cosmetic renovations like new flooring, cabinets, lightings, oftentimes those qualify for accelerated depreciation. Furniture, appliances, and electronics are also things that generally fall under bonus depreciation, which due to the big beautiful bill and bonus depreciation being 100% quote unquote permanently. So what I'm actually going to do right now is show you guys what this looks like and why it actually matters. So let me what is that property address? Bear with me. So on BNBCalc, we got it for $735. Purchase price matters, guys, because you're doing depreciation based off the purchase price, not the tax assessed value or anything like that. So we think it should do about $1,200 a night, be occupied probably under half the time. But what I want to look at is actually the STR tax calculator. Just say I was, hypothetically making $250,000 a year. That probably puts you at about 33% tax bracket. You obviously should know your tax bracket, your federal tax bracket, that is. If you go down, you can deduct interest, you can deduct the property tax, which this is pulled from tax records, and then depreciation. So what's really important here is the structure value. So if this is a more rural property, it might be like more 80, 90%. If you're urban, beachfront, anything like that, the land might be more valuable. So then the structure value proportion, so the ratio of the structure value to the total value might be lower, which is not good for, having a depreciable asset. Because again, you can only depreciate the property itself. You can't depreciate the land. So, we can throw in furniture and repairs. So if the structure value is 80% versus 70%, you see that's an extra 70 grand or so in depreciation. But again, bonus depreciation 100% this year might mean a couple $100 grand, about a $200,000 depreciable base. Obviously, if you're spending more on furniture, repairs, anything like that, that number can definitely go up. We don't have any more bonus depreciation because we're using it in year one, but we also have assets that qualify for standard depreciation. So that's still per this example, could be about $10,000 more. This particular property, if it's doing really well and we have it up for the full year, it could show big profit. But we're not going to get this one up the whole year because we got it up, March, April, don't have as much lead time. But if we got it up maybe towards October, even lower. But we're just going to run it here. So after subtracting the operating profit, the total deduction is 112 grand. So now you're going to have this loss of 112. You're going to deduct that from your initial income of $250,000, and you're left with 137 grand in income. So tax on that, and actually technically you should be at a lower tax bracket now, but BNBCalc doesn't want this to be too complicated. Taxes on 137 grand, assuming the same tax rate, which again, it could be lower, it could be 45 grand. Initially you were going to pay roughly 83 grand. Now you're paying 45. That is a $37,000 tax savings. And there are other ways, this could actually be higher. But I just wanted to show you guys an example using BNBCalc. Tax savings are important. Definitely consult your accountant before making any investment decision. The tax aspect is really just part of this game. I personally like finding and transforming high potential properties that drive serious revenue. That's something that I enjoy, and that's what's allowed me to do this full time. We also do work with a small number of high income earners on an individual one-to-one basis to help them go about this process smoothly, efficiently, and effectively as possible. So there's a link to an introductory call with our BNBCalc concierge service, as well as a 7-day BNBCalc free trial below. If you found this video helpful, please give it a like, subscribe to my channel, and I have other videos meant to help you guys out here. So make sure to check those out.